In this video, I'll show you how to execute a bull put spread on Interactive Brokers. By the end of this video, I'll be demonstrating on how to sell a bull put spread on the stock Rivian on Interactive Brokers so you can follow it step by step. This is another strategy you can utilize to help you get additional income from options trading. The best way to learn is teach. That's what I'm doing. I'm referring to a blog post from Options Alpha, and the resources they have is extremely good, so I'll be using this write-up that they have in terms of explaining what is a bull put spread. Skip here to this time code for me to demonstrate immediately on Interactive Brokers. I'll first explain what a bull put credit spread is for beginners. A bull put credit spread is a multi-leg, risk-defined, bullish strategy with limited profit potential. The strategy looks to take advantage of an increase in price in the underlying asset before expiration. As a strategy highlight, you only want to execute a bull put credit spread when you're bullish. When you're bullish, you're simply expecting the price of the stock to increase in the duration in which you are trading the options on. For this strategy, you're a net option seller. You receive money to enter a put credit spread. You're basically collecting money when you execute this trade. From a strategy setup standpoint, put credit spreads have two legs. You'll be selling one put option and buying one put option which is lower than the strike price at which you're selling the put option on. The downside of this strategy is that there's a limited profit potential. There's only a maximum amount of money you can earn, but the good thing is it is a defined risk strategy. There's only a maximum amount of money you can lose. Put credit spreads works best when volatility decreases. I'll say this is a little bit more advanced. Some examples that causes a decrease in volatility includes the period of time after an earnings call. Next thing, time is your friend. Put credit spreads benefit from the passage of time. Assuming the stock price goes up over the period of time when you have traded your bull credit spreads, you will be earning money every single day because your put credit spreads becomes more valuable every single day. How to set up a bull put credit spread? A bull put credit spread is made up of a short put option with a long put option purchased at a lower strike price. This here is an example. I'm selling a put option at $14 and I'll also be buying a put option at $10. You can buy a put option at $12, $8, $6, $4. The credit received is the maximum potential profit for the trade. Let's assume I collect $100 when I sell this put option at $14, and let's say when I buy this put option it costs me $50. Because I collected $100 here, and because when I buy the put option assuming it costs $50, that means I'll receive a net total of $100 minus $50 equals to $50. So if I were to execute a bull put spread here, I will collect a total amount of $50. The closer the strike prices are to the underlying price, the more credit will be collected, but the probability is higher that the options will finish in the money. To demonstrate this using Rivian, if you are selling this put option to be as close as possible to the underlying stock price, which is currently at $15.48, the more money you'll collect. But because the strike price that you have chosen your put option is much closer to the actual price of the stock, there is a higher chance for it to breach this, and when it breaches this, it means the options will be in the money, and if it's in the money, it means you'll be losing money from this trade. The larger the width of the spread between the short option and the long option, the more premium will be collected. An example of a large width would be this. You're selling a put option at $14 and maybe you're buying a put option at $3. And if you're doing this, you collect a lot more money, but the maximum amount of money you can lose here is a lot more. I'll give a demonstration of this later on Interactive Brokers. On the other hand, if you shift this long put option here to be much closer to the price at which you sold the put option at, which is maybe $12 here, the maximum loss here will be much smaller, but the downside here is that the money you collect will be much lesser. I'll now move on to demonstrating this on Interactive Brokers. I'll highly recommend you to use the Trader Workstation on Interactive Brokers. It is a little bit more difficult to execute it on the web platform, so I'll highly recommend that you use it. When you open Trader Workstation, it can look very intimidating with a lot of things over here, but I'll demonstrate to you step by step to execute a bull put spread strategy. Make sure the layout here is unlocked. Click on New Window, click on Portfolio, click on New Window, click on Order Entry. So step 1 on Interactive Brokers, you need to sell the put option. So let me use the stock Rivian here as an example. I'll go to Order Entry, click RIVN, which is the ticker that you want to trade a bull put spread on. Click on Stock over here, and when you do that, wait for the option chain to load. Step 2, choose your days to expiration. Usually when I do a trade like this, I'll trade maybe about 30 to 40 days. That's my preference. The shorter that you trade it on, the much riskier it is. As a disclaimer, I've lost a lot of money when I traded very short dated bull put spread, so I'll really recommend you to be careful. Always use paper money in terms of trying out a new strategy. The next thing I want to do is sell a put option at $14. So I'll go to Trader Workstation, find $14 over here. For complete beginners, you can use the strategy builder, but it's actually something I'll not recommend for more advanced traders, which I'll share later why. Click on strategy builder if you're a beginner, find $14, click on sell options over here, and then the next thing you want to do is to buy the put option at a lower strike price. Going back to my screenshot here, the put option that I'm buying at is at $12. So let me find $12. In this case, there isn't $12, but the closest one is $12.50. So I'll just buy $12.50. Make sure you click on buying, okay? Don't click sell, click buy. So I'll click buy over here. It should give you a summary over here, bull put. When it says this, you know that if you submit a trade like this, you'll be trading a bull put strategy. The next thing I want to do is to understand my risk profile and maximum profit or loss. What I'll do next is click on profile, and you need to understand basically what's happening over here. It looks very complicated. So if I were to proceed with this trade, the maximum amount of money I can earn is about $36. The maximum amount of money I can lose is $113. If the price of Rivian is above $14 by the 23rd of February, it means I get to collect my $36 fully and I don't have to do anything to close my trades. But in the case if the price of Rivian is below $14, there might be a chance that I'll lose somewhere between $0 all the way to $113. This is the performance graph I can see here. You can choose it on different days. You can choose it on February 23rd, which is the day it will expire worthless. If the price of Rivian is above $14, as you can see here, you'll earn a maximum of $36. But if it is, let's say, $13.70, you can see that my profit on the right hand P&L would change. If the price of Rivian on the 23rd of February is $13.79, I'll only earn a total of $14.70. But in the case if the price of Rivian is $12.99, as you can see here, I'll lose a total of negative $65. And if the price of Rivian goes below $13.64, as you can see here, it means that I'll start to lose money. The break-even price of Rivian here I need it to be at would be $13.64. As long as the price of Rivian is at $13.64 or above by February 23rd, I'll then earn money accordingly. This just gives you a rough understanding of what might happen, and that's where it's very important for you to understand the performance graph of any bull put spread or any multi-legged strategy that you trade on. Another thing I like to do is to see how much I can earn halfway through the trade. So there are 33 days to 23rd February as of today's recording. How much money would I potentially gain in 15 days? So the date today I'm recording this video on is on the 21st of January 2024. So 21st of January plus about 15 days, I think it's early February. So maybe let's select February 6th, okay? Let me see the payoff profile here. For me to earn money, I need the price of Rivian to minimally be at $15, okay? So right now, if you can see in the P&L on the right hand side, this P&L here is always positive and I'm seeing the price associated with the P&L. So if I want my trade to earn 16 cents, the 0.166 you see there, the price of Rivian needs to be at $15.08. If the price of Rivian is $16.52 on the 6th of February, my trade would have earned $19.40, and this is how you see the profit profile accordingly. I'll encourage you to click the graph one by one. You can see the dotted line here. Over time, this dotted line would move towards a solid line, which is the payoff profile on the February 23rd. So if you can see here, if I choose something like February 16th, you can see that the dotted line is much closer to the February 23rd payoff profile. So let's say in this case for February 16th, if I were to just go along this graph over here, I can see how much I need the price of Rivian to be at for me to be profitable or not. If the price of Rivian is at $14.43, my trade will have tentatively lost $0.60, which is 60 cents. You can also look at the scenarios below here. If the price of Rivian is $10.85 on the 16th February, I would have tentatively lost $107. And if the price of Rivian is at $20.15, my bull put spread will have earned $35.97. I'm going to take a screenshot of this bull put spread and I'm going to compare it to a bull put spread with a wider width. Let me go back to this graph. Instead of buying a put option at $12, let me move it to maybe $6. So to execute a bull put spread with a wider width here, I'll sell a put option at $14 and I'll buy a put option at $6 with the same dates to expiration. So let me choose 23rd February where there are 33 days to expiration. Cancel here and I want to find $6. So in this case, there's no strike price at $6. The strike price I can find is maybe $7.50. So let me go back to the graph here. Let me change this to $7.50. Previously, my long put was at $12.50. I'll now move it to $7.50. Ensure that you click buy options, not sell options here. Okay, so I'll click buy here and make sure it's bull put over here. If it's bull put here, you have selected the correct settings. Click on profile. So one thing you'll realize here is that your max return is a lot higher. Let me take a screenshot of this and let me put the performance profile side by side. Now this is a comparison of both bull put spreads. One of them is selling a put option at $14 and buying a put option at $12.50. The other is selling a put option at $14 and buying a put option at $7.50, which has a much wider width over here. And as you can see here, the most obvious thing is that the max return is a lot higher. If you're executing a bull put spread with a larger width, the max return is higher, but as you can see here, the max loss is a lot more as well. At the end of the day, it's just about balancing your risk-reward ratio. Do you think this risk is worth it or not? Let's do a quick calculation here. Assuming you don't manage your trades at all, if you want to potentially earn $65, the worst case scenario that can happen is that you lose $582. So losing $582 relative to $65, it's a 8.95 ratio. So for every dollar you earn here, you're risking $8.95. That to some people is quite a big bet. For me to earn $1, I'm risking $8.95. If I were to do a quick calculation here, I'll take 113 divided by $36, and that is a ratio of 3.13. That means for every dollar I want to earn, I'm potentially risking about $3.13. But that to me is not ideal because no one in the right frame of mind would let a bull put spread expire at the maximum loss, because in a case where the trade goes against you, you want to cut your losses immediately. The topic of managing a bull put spread is a very complex one, but for complete beginners, if you ever trade a bull put spread where it turns out to be a losing trade where the price of Rivian goes down below $14, I'll actually recommend you to close the trade immediately and not lose so much money. You don't want your bull put spread to expire with maximum loss. You want to cut your losses. In this case, it is likely that you'll lose much less than $113 here. If there's one thing I can emphasize about bull put spreads, make sure your width isn't too much, and I'll really encourage for beginners for your bull put spreads to be as close as possible, because if it's as close as possible, that gives you the maximum protection accordingly. In this case, let me change it back to a long put at $12.50, and I'll click profile over here, click submit order, and you'll see the total amount that you'll collect. It's NA right now because the market isn't open. I'll highly recommend you do a manual calculation to know exactly what you're doing. Let's say you sell a put option and collect $73 over here. So you collect $73 and it costs you $34 to buy this put option at $12.50. So I'll minus $34, okay? And that's the estimated amount of money you will collect. The next question you probably have is, hey, why is this number you see on the calculator, $39, different than $36 over here? And this leads me to my point on using the strategy builder option over here. For complete beginners, I think it's fine to use a strategy builder, but in the case if you're an intermediate to advanced trader, and if you want to earn a little bit more money, I'll actually recommend you making these two trades separately. Why? Because for each single trade, there's a bid and ask. If you're able to sell a put option and collect more money at $78 over here, how I got $78 is 0.78 times 100, which is $78. Let's assume that selling options trading is like going to sell fish. I'm a fishmonger, I go to the market and sell fish. I'm selling my put option at $14 at $73. Of course, people want to buy it for me, but if I sell it at $78, not many people want to buy it for me. But if I manage to sell my put option at $78, then I can potentially earn more money, because when I buy the put option, I already have collected $78. In two scenarios, let's assume in scenario one, I managed to sell my put option at $73. And let's assume that when I go and buy my put option, if I want to buy the fish at $34, that will result me in a net of collecting $39. But if I sell my fish at $37 and I buy the fish at $37, that will leave me a profit of $36, right? In this case, when you make the trades one by one, you're able to have more negotiation power. For you to execute this, it is very important for you to have live trading data. And if you're not paying $20 per month on Interactive Brokers for live trading data, it means you don't have it, and I wouldn't recommend it for you. But if you want to save the extra money, that few dollars on commissions, right, this is something you can potentially do. First, try and negotiate and get the best price possible for your put option. In this case, if I can sell my put option at $78, that'll be the best case scenario. And the best case scenario for me buying a put option would be at $34. So if I take $78 minus $34, it means the maximum profit for this trade would be $44. This is a lot more than $36 that I'll collect. So for advanced traders, I'll recommend you making the trade separately. From my experience in trading credit spreads, I'll recommend people to set a hard stop, okay? You must tell yourself, okay, if I lose this X amount of money, I need to exit the trade immediately. That's why I recommend for complete beginners, because when it comes to managing credit spreads, there are actually a million ways you could manage a credit spread. You could open a call credit spread and turn it into an iron condor, which is more of an advanced strategy. You could actually buy additional puts. Now, in what situation should you never sell a bull put spread? Never sell a bull put spread when there is low implied volatility. When the IV is low, the premiums received from selling options are also low. This means the potential profit from selling a bull put spread is limited. In a low IV environment, the market is typically stable and there's less chance of making a significant profit from the volatility expansion. The risk-reward ratio ratio in such scenarios is not favorable as the potential gain is small compared to the potential losses. So when you're trading a bull put spread, you must pay attention to the IV. If it is a stock that has relatively low IV, like let's say Coca-Cola for example, as you can see here, the IV of Coca-Cola is at 11.3%, significantly much lower compared to Rivian. So when it comes to these kind of stocks, I'll usually never trade bull put spreads. I'll only trade on bull put spreads where the IV is a little higher. The higher the better. Usually if it's above 35 to 40 to 45%, that's where I usually like to trade bull put spreads. Of course, when you trade something with higher IV, that means it is a lot more riskier. You need to know what you're really doing before you trade bull put spreads on stocks like Rivian or any other stocks with high IV. If you're not sure what the IV is specifically for each stock, just click the stock that you want to potentially trade bull put spreads on, and you'll be able to see the IV associated with the stock based on the time duration. When you change the time duration, usually the IV changes along with it as well. So as you can see here, for 26 days left to expiration, we have an IV of 66.4%. For 33 days, we have an IV of 75.1%. Stay away from trading bull put spreads where IV is low. In this case, the earnings for Rivian will be on the 21st of February. So you can expect IV to increase during this period. Let's assume that IV here is 50%, and let's assume IV here is maybe 150%. And if the price of Rivian falls drastically below $14, this is where you might potentially lose a lot of money. When it comes to the specific calculations, it really depends, but long story short here, you want to avoid these kind of situations where the IV increases. The ideal situation to sell bull put spreads will be higher IV environments. Let's assume that Rivian does very well in this upcoming earnings call. If you sell a bull put spread close to earnings over here and Rivian does very well and the stock price of Rivian shoots up by a lot, this is where you can potentially earn a lot of money. And the reason why you can potentially earn a lot of money is because after earnings, the IV of the stock will usually drop a lot. So let's say it drops from 150 to maybe about 30. In the case where IV drops from 150 to 30, it'll be much cheaper to close your positions, and when it's cheaper to close your position, it means you're a lot more profitable at a faster rate. But the risk is also a lot higher as well. So with higher risk comes higher reward. So this really depends on your risk tolerance. But for complete beginners, I would say I would recommend you not to trade. Or even if you want to trade, practice a lot on paper money before you know what you're doing, and make sure a position size is extremely small relative to your overall portfolio size. There are other reasons here: lack of adequate risk management, and when you're not comfortable with the underlying asset. I think these are small things. I would highly recommend you to learn a lot more about IV crush. I think that's one of the very key important factors when you want to learn about options trading. It is very, very important for you to understand IV crush. Let me know if you have any questions, and I'll see you in the next one.